What's up, tax savers? So we're kicking off, as promised, a series on everyone's favorite topic right now, tax reform. So as I go through this, I'm gonna have my notes handy because unfortunately, I can't be an expert on something that just was released in the last couple weeks. And there's still even a lot up in the air. What we do know is that the bill has passed the House and has passed the Senate. So some form of major reform is going to be happening. And it's currently in the budget office trying to figure out and reconcile the differences between the two plans of the House and the Senate. There are some common tenets of the two, though, that we'll be going through that if they align, they're probably gonna end up being in the final bill. So the ones that differ, I'll highlight those, and then those might change, but at least you're aware of what is coming. So tax brackets. We've talked before about what marginal tax bracket means. That's the, and maybe Andy can link up a video right here when we share it, but or in the comments. But your marginal tax rate is what you're taxed on every additional dollar you earn, not what all of your money is taxed at. So if you're in the 25% bracket, it doesn't mean all of your income's taxed at 25%. This is one area the House and the Senate differs. So the House wants to break it down to just 4 brackets, 12, 25, 35, 39.6. The Senate wants 7 brackets, which is closer to what it is right now. Overall, that number's not gonna probably dramatically affect you that much. What will affect you, and for a lot of people across the board that itemize, and that means you write off your mortgage interest, your charitable contributions, medical expenses if you have them, they're dramatically increasing the standard deduction, which right now was about $14,000. That's going up to $24,000. So for a lot of you, that's going to make your tax we got an angry mascot in the background here. Let her run. So that's Boston, our resident angry man dog. Okay, back to where were we? Our new standard deduction is going to be for a married filing joint person about $24,000, which means it's going to make your tax filing a lot simpler. So if you're thinking about buying stock in TurboTax, I'd do that now. So most people aren't going to be itemizing anymore because just the fact that your mortgage interest plus your charitable contributions plus state income taxes is pretty much the 3 factors that cause you to itemize. We're losing the state income tax deduction for the most part, and so most people aren't going to be itemizing anymore. So in a separate video, we're going to break down why you should prepay your state income taxes and property taxes right now if you're in that itemized deduction threshold. So first and foremost, the most simplest thing that's going to affect you is going to be probably you're going to start having a standard deduction instead of an itemized deduction, and then your exemptions goes away, meaning you get an extra deduction for having yourself and your spouse and then each child or dependent you have. Right now you get $4,000 of a deduction per child and dependent you have. They're going to change that, and that's factored into the overall bigger standard deduction. So we'll break down more in future posts, but first and foremost, that's going to affect most people, so I wanted to hit it first. We'll see you next time.
So take note how I spend my days. Been searching for reasons to maintain my